I can't tell you how much I love this tool. It's this is I've been wanting to build this for months, for a couple of reasons. One, the distribution of probable economic outcomes and policy outcomes in a fourth turning is as wide as we've ever seen. Two, the fourth turning poly crisis took a big step forward in 2025. And so it's making it harder to do just connect the dots with fundamental research alone. There's so much stuff you need to cover. There's so many, like if this was a war, there's just so many battlegrounds and like there's so many dimensions of war now as investors that we have to deal with. And so it's so important for us to broaden and enhance our our observation capabilities. Our at its core, 42 macro is one of our competitive advantages relative to a lot of firms that have significantly worse performance than we've had over the past half decade. One of our competitive advantages is that we're big on observation. Most people think prediction is better than observation. We do not subscribe to that view. We and the best investors in the world do not subscribe to that view. We subscribe to the observation is more important and more valuable to staying on the right side of market risk than prediction. And so obviously we built this litany of tools here to help us observe the economy and asset markets better so that we can notice critical inflections in the key macro cycles that matter, as well as critical inflections in the momentum and dispersion of asset markets faster than other people. That's it. That's the job. You got to notice it before everyone else does and execute your trades before they do. You don't have to predict what's happening. I don't care what happens in the financial markets. I care about making sure that my buys go in before the rest of the crowd's buys and my sells go in before the rest of the crowd sells. I don't care if we're in bull or bear market. I don't. I really don't. But what I care about is making sure that we are ahead of all of us, Team 42, our global investor community, is ahead of the crowd. And so this new tool, this enhanced macro weather model, is going to help us do that at a higher degree. So without further delay, the macro weather model, I'm not going to worry about the old one. The new one is organized according to the 6 key macro cycles that matter. So it's growth, it's inflation, it's monetary policy, it's fiscal policy, it's liquidity and positioning. There's the only 6 things that impact asset markets from a momentum and dispersion perspective on a trend basis. Trust me, I've back tested a lot of other stuff. I don't have enough time or stupidity to backtest government shutdowns or tariffs, but I can assure you that you're not going to be successful in those backtests. Certainly not when you control for the influence of these cycles and try to remove that. So the reality is me and a bunch of other smart investors, as well as some best investors of all time, if you listen to them and read their books and study what they say on TV and on the news and just generally pay attention to what the best people in the game are doing, I've never heard any of them talk about anything that wasn't one of these 6 cycles. And so my education on Global Wall Street has been trying to build tools and build processes and create charts that help me track these cycles better. And so that's exactly what this new this enhanced macro weather model is going to do. So let's unpack each of these key macro cycles. So we'll start with growth. So in terms of the indicators that we use to track growth, so it's real GDP, ex-government, and exports. That's at a strong negative impulse currently. Real personal consumption expenditures is a strong positive impulse. The private sector labor income is a strong negative impulse. S&P 500 next 12-month earnings per share, that's a strong positive impulse. And then the consensus short-run potential real GDP estimate, which is the blend of the next 2 years, so that's 2026 and 2027, that's a weak positive impulse. So on net, the growth cycle is a tailwind for asset markets currently. Transition to the inflation cycle. Headline CPI is a weak positive impulse. Core PCE price deflator is a weak positive impulse. The CRB index is a strong negative impulse. The 5-year US dollar inflation swap rate is a weak negative impulse. The consensus short-run potential headline CPI estimate is a strong positive impulse. And so on net, the inflation cycle is a headwind for asset markets currently. The transition to the monetary policy, Fed funds rate is a strong easing impulse. The 2-year nominal treasury yield minus the Fed funds rate spread is a weak easing impulse. And then we have a strong tightening impulse in the Fed Treasury holdings marketable treasury debt ratio. We have a strong tightening impulse in the bank reserves commercial bank assets ratio. And then we have a strong tightening impulse in the SOFR IRRB spread. So on net, the monetary policy cycle is a headwind for asset markets. And a lot of this is coming from the fact that the Powell Fed is, committing another policy mistake. If you look at fiscal policy, sovereign fiscal balance to GDP ratio, that's a strong tightening impulse. The trailing 12-month federal revenue, that's a weak easing impulse. trailing 12-month federal expenditures, that's a strong tightening impulse. Treasury general account balance to bank reserves ratio, that's a strong tightening impulse. And then bills to marketable treasury debt ratio, that's a weak, easy impulse. And so the market risk assessment for the fiscal policy cycle is currently a headwind right now. Transition to liquidity. If you look at 42 macro global liquidity proxy, so that's the aggregated sum of global central bank balance sheets plus global broad money supply plus global FX reserves minus gold. That's a strong positive impulse, a strong negative impulse in the 42 macro net liquidity, which is Fed balance sheet minus TGA and RRP. The move index is a strong easing impulse. 10-year treasury term premium is a weak easing impulse, and then the U.S. dollar broad nominal effective exchange rate as a weak tightening impulse. So the liquidity cycle is currently a tailwind for broader asset markets, and then positioning cycles ad nauseum been talking about all day and all week. The positioning cycle is at a material headwind. If you look at the current implied positioning for the positioning cycle indicators, so these are organized. They're ranked right now in terms of the degree of dispersion that we've historically observed in these positioning cycle indicators at major bull market peaks and bear market troughs. So the more dispersion you have in the indicator, the more clean the signal is, and so we trust it more. And so the current implied positioning in the name National Association of Active Investment Managers Stock Exposure Survey implies the positioning cycles in the 85th percentile. In direction bullish, so the higher is obviously bullish. That's well above its pre-crash, pre-crash mean. If you look at the three biggest crashes we've seen since 2000, it was the everything bubble popping in 2022. It was the global financial crisis, obviously, in the dot-com bubble. And so we're well above that pre-crash mean. If you look at the S&P 500 price to next 12-month earnings multiple, we're in the 96th percentile in terms of its implications for positioning. And so well above its pre-crash mean. If you look at the S&P 500 implied 3-month implied volatility correlations, 95th percentile, well above the pre-crash mean. AII bulls bear spread only in the 39th percentile, well below the pre-crash mean, so that's positive at the margins. And then U.S. investment grade credit spreads, 96th percentile in terms of the implied positioning from that indicator, and well above the pre-crash mean in terms of being lopsidedly bullish. So each of these key macro cycles corresponds independently to each asset class, much like the previous weather model. And so the current constellation of composite signals, so if you look at the bear signal for stocks, gold, Bitcoin, and commodities, gold is obviously new in terms of adding gold, and then the bullish signals for bonds in the U.S. dollar, they currently indicate a low probability of sustaining a risk-on market regime over a short to medium-term time horizon, which again, in our risk management nomenclature, is 1 to 3 months. So this is telling you that, hey, there's a lot of negative stuff developing at the margins. We knew inflation was a problem over the near term. Monetary policy was supposed to get better, but now it's getting worse again because of the Powell Fed's major policy mistake. Obviously, growth, we're in this U-shaped economy, so the markets have been looking through the left side of the U, which we told them to back in April. Fiscal policy, we know we're in a U-shaped fiscal policy cycle as well. We have the fiscal retrenchment from tariffs that's going to eventually explode into fiscal easing from the one big ugly bill. So we know that I think markets are able to look through the tariff impact as well. And then liquidity is still it's still an ongoing tailwind. And then so what's changing at the margins are monetary policy and positioning. And boy, you don't want to have an adverse outcome in the monetary policy cycle when you're at such a lopsidedly bullish positioning cycle. So this is the kind of stuff where corrections, particularly material corrections, develop. And so I don't want to mince words about this. If the Powell Fed sticks to its backward-looking failed framework and anchoring on this, this unicorn of 2% inflation at the expense of the recession, the 3-year recession at the bottom of the K in the U.S. economy, market probably can and will crash. Markets reserve the right to do whatever they want. It's not my job to tell them what to do because of Paradigm C. The Paradigm C could take a deep intermission, and I'm totally fine with that outcome. Are you? I'm fine with it. I know Kiss and Dr. Mo they're not going to sell the exact top. They're not going to buy the exact bottom ever. But what they will do is chop off the left tail of the distribution. You're not going to ever not have error in your forecast. You're not only going to have, if you think my investment process or your investment process or anyone's investment process, including the all-time greats, only has a right tail of the distribution, you're wrong. They'll tell you themselves that, hey, we're only right 50% of the time. So it's our job as risk managers is to mitigate how much of the left tail of the distribution we realize in our portfolios. And Kiss and Dr. Mo doing a phenomenal job at that, with a 57% downside capture ratio relative to 60-40 and a 50% downside capture ratio relative to a naked long portfolio of 60% stocks, 30% gold, and 10% Bitcoin. So that's about as good as you're going to get, certainly at this price point. You can pay 3 and 30 and maybe get a little bit better, but not much. And then finally, wrapping up, with the U.S. government shutdown exacerbating the Powell Fed's latest policy mistake. I only got one chart on that, and this is a great chart to end on. The K-shaped economy crisis may not be a crisis to some, particularly the folks around defending the Powell Feds and the Fed in general, the institution's legacy of policy mistakes. They may not feel like it's a crisis because they're eating $1,000 lunches at the Economics Club of Washington and flying around the country doing fireside chats and on in private jets and on the American taxpayer's dollar. They might not be feeling the bottom of the K like the millions of 65 to 70 million low to median income households in the country. But I can tell you those people are feeling the bottom of the K. They've been in recession since 2022. So this chart shows several indicators which highlights just how damaging the economic outcome has been for the, more at this point, it's probably more than half of America. So if you look at under 35-year-old homeownership rate, that's declined 4.2 percentage points to 36.4% since the peak in 2020. It's actually declined 7.2 percentage points to 36.4% since the peak in 2004. So the American dream is going in the wrong direction. That sucks, and at a faster rate, by the way, in this post-COVID K-shaped economy. This is where things get really interesting, particularly these two panels. If you look at U.S. credit card delinquency rates, nationwide aggregate U.S. credit card delinquency rates, it's 12.4%, which is basically near the high we reached after the global financial crisis and the Great Recession. But again, we know the rich people in the top part of the K are doing just fine. Business is booming. They're flying around in private jets and they're having a great time. But we also know that if these guys are booming, just think about how much the bottom must be busting in order for the aggregate credit card delinquency rate to be at a level that is consistent with the global financial crisis and Great Recession. In fact, if you look at the auto loan delinquency rate, it's making an all-time high, essentially. Next data point, I guarantee, will be an all-time high, higher than the GFC, higher than COVID. When did this degradation start? It all started in 2022 when the Fed took the policy rate up to 550 basis points. Didn't bother the people on the top part of the cake because guess what? They are flush with cash from the trillions of dollars of PPP, forgivable PPP loans that people were buying private jets with and flying around to youth hockey tournaments and all this good nonsense with. And this is the top part of the K. The $10 trillion in the household sector balance sheet is sitting on the top part of the K, and it's financing their consumption, it's financing their lifestyle, and everything's great. But if you didn't get the forgivable PPP loans and you only got a $600 check from the government, and you're being crowded out by the excessive growth of the public sector balance sheet, and the Fed's not doing anything about that in terms of making the supply and the cost and quantity of capital more easy for the folks in the bottom part of the K. If you're in the bottom part of the K, you feel like you're in the global financial crisis. You feel like you're at the trough of the Great Recession. And so this is the point we're making. This is not just saying this stuff because it's cool to talk about. It's not cool to talk about. I don't want to talk about a K-shaped economic crisis. And the reason we bring this up is because ultimately we believe the institution, the Federal Reserve, is going to be forced into addressing the K-shaped economy by credible thought leadership from the next Fed chair and from credible sources like myself. And we had Claudia Sahm post that op-ed in the Bloomberg this week. Hello, Claudia Sahm is a former senior economist at the Federal Reserve. I'm not crazy. I might be early. We tend to be early in terms of I think we do more research than anyone. I don't know if anybody pumping out hundreds of slides of research every week. So we tend to be early, but I'm definitely not crazy on this K-shaped economy crisis and the Fed's ultimate response to it. But we might have to go through if this is paradigm C, if this is realizing paradigm C's upside risk, if the Powell Fed policy mistake, we might have to do something like this to ultimately realize that. I hope not. This is kind of where you are here now. I'm hoping this part is truncated by incremental pivot back to in the right direction from a monetary policy signaling standpoint, but it might not be. So just be aware of that. So Darius Dow here wrapping up our Around the Horn for Saturday, November 8th, 2025. Best of luck out there. Just remember, it doesn't matter. The outcomes don't matter. All that matters is making sure that your buy orders are ahead of everyone else's and your sell orders are ahead of everyone else's. And that's exactly what KISS and Dr. Mo are designed to do. So go to sleep, trust KISS and Dr. Mo. Have a great weekend. We'll catch you back here next week. Cheers.